The U.S. housing market is facing a paradox. Home prices have skyrocketed by about 40% during the pandemic, reaching unprecedented levels. At the same time, mortgage rates are hitting record highs, a phenomenon not seen in decades. The average 30-year mortgage rate has skyrocketed to over 7%, surpassing levels that once seemed unthinkable. This surge is squeezing potential buyers out of the market and signaling a tipping point that could lead to a rapid unraveling of the housing market's stability. To understand why this housing market crash will be worse than the previous one, it's crucial to understand the landscape of today's housing market. It's a market that has experienced unprecedented growth. But beneath the surface, there are signs of strain that could lead to significant shifts. In recent years, we've seen a real estate boom like no other. Home prices have soared to record highs, driven by a combination of low interest rates, limited housing supply, and a surge in demand. This demand has been fueled partly by a new generation of home buyers and partly by investors looking to capitalize on the market's upward trajectory. However, this rapid growth has brought with it a significant challenge: soaring mortgage rates. These rates have climbed at a pace that's left many potential buyers grappling with affordability issues. The higher rates mean higher monthly payments, pushing the dream of homeownership out of reach for a growing segment of the population. This situation is further complicated by the broader economic context. Inflation is on the rise, affecting everything from construction costs to everyday living expenses. The combined effect of high home prices and increasing costs of living is creating a pressure cooker scenario. For many, the question is no longer just about finding the right home, but whether they can afford a home at all. Amidst these challenges, the market is also showing signs of cooling. Homes that once sold in days are now seeing longer listing periods. Price reductions, once rare, are becoming more common. This shift is a clear indicator that the market is reacting to the changing economic conditions, and it raises questions about the sustainability of the current price levels. It's clear that we're at a pivotal moment. But to truly grasp the potential impact of what lies ahead, we need to turn the pages back to a defining chapter in our recent history. Let's rewind to 2008, a year that shook the world's economy to its core. This wasn't just a crash. It was a dramatic fallout from a series of deep-rooted problems in the housing and financial sectors. Picture this: the 2006 housing bubble, inflated by a frenzy of speculative investing and an influx of easy credit. Lenders, in a race for profits, handed out subprime mortgages like candy at a parade, often to those least able to afford them. These risky loans were then packaged into exotic financial products, sold globally. Investors, lured by high returns, snapped them up, not fully grasping the danger lurking beneath. But as home prices plummeted, the reality hit hard. Mortgage defaults skyrocketed, and these once attractive securities turned toxic, triggering a financial contagion that spread far and wide. The fall of Lehman Brothers was the tipping point, a moment that turned a crisis into a catastrophe. It wasn't just a big bank going under, it was a domino that knocked down economies worldwide. The aftermath? Devastating. Jobs vanished, businesses collapsed, and governments worldwide scrambled to prevent a total economic meltdown. Unlike 2008, today's brewing crisis is driven by different but equally potent factors. Record-high mortgage rates are making home buying increasingly unaffordable. Inflation is surging, eroding purchasing power. And there's a growing concern over mortgage defaults, reminiscent of the pre-2008 era. But as we emerge from the shadows of the past, we must confront the realities of today. The question now is, what is the cause of this upcoming housing market crash? As we turn our gaze to the present, several critical factors are converging to signal a potential housing market crash. This isn't just a repeat of the past, it's a unique set of circumstances shaping a new kind of crisis. Firstly, let's talk about mortgage rates. They're not just rising, they're soaring to levels we haven't seen in years. This surge is more than a number. It's a barrier. It's pushing the dream of homeownership out of reach for countless potential buyers, cooling down the once red-hot demand. But it's not just about affordability. These high rates are also a stress test for current homeowners, particularly those with adjustable-rate mortgages who are now facing steeper monthly payments. Then there's inflation, a silent yet powerful force. It's not just nibbling away at your wallet. It's reshaping the entire economic landscape. As the cost of living climbs, the ripple effects are felt everywhere, from the price of building materials to the overall cost of owning a home. This inflationary pressure is squeezing budgets and altering the calculus for both buyers and sellers in the housing market. Another looming concern is the rise in mortgage defaults. This is particularly worrying as it echoes the pre-2008 scenario. With higher mortgage rates and economic uncertainty, more homeowners may find themselves unable to keep up with payments. This increase in defaults could lead to a rise in foreclosures, adding more properties to an already cooling market and potentially accelerating a decline in housing prices. Experts are watching these indicators closely, and the consensus is unsettling. The combination of skyrocketing mortgage rates, rampant inflation, and the risk of increasing defaults is creating a precarious situation. It's a cocktail of economic pressures that could lead to a significant market correction, one that might mirror the past but also has the potential to carve its own disruptive path in economic history. Now let's focus on the elephant in the room, the housing market bubble. This isn't just a term thrown around by economists. It's a real and present danger. We're witnessing a market that has ballooned to extraordinary proportions, driven by years of low interest rates, aggressive lending practices, and a frenzy of buying activity. But as we've learned from history, every bubble has its breaking point. As we stand on the brink of what could be a major housing market correction, the question on everyone's mind is, how do we prepare? The key lies in proactive planning and strategic decision-making. Let's explore some essential steps to safeguard your financial future in these uncertain times. For homeowners, the first step is to assess your mortgage situation. If you're on an adjustable-rate mortgage, consider the benefits of refinancing to a fixed-rate mortgage. This could offer stability and predictability in your monthly payments, especially important in a volatile market. It's also crucial to build an emergency fund. Aim for a reserve that covers at least 3 to 6 months of living expenses, including your mortgage payments. This safety net can be invaluable in times of economic downturn. For those looking to enter the market, caution is the watchword. Be wary of overextending yourself financially. Stick to a budget that allows for potential market fluctuations. It's also wise to research and understand the local market dynamics thoroughly. Look for areas with strong, long-term growth potential, rather than just short-term gains. And remember, the best time to buy is when you're financially ready, not necessarily when the market seems at its peak. As we navigate these uncertain times in the housing market, remember that knowledge is your most powerful tool. The potential for a market crash may seem daunting, but understanding the dynamics at play empowers you to make informed decisions. Whether you're a homeowner, a prospective buyer, or an investor, the key is to stay informed, remain vigilant, and approach the market with a balanced perspective. It's not just about weathering a storm, it's about finding opportunities in the midst of challenges and making choices that align with your long-term financial goals. Thank you for joining us on this journey through the complexities of the housing market. If you found this video insightful, please like, subscribe, and hit the notification bell for more updates and analyses. Together, let's stay ahead of the curve and navigate the future with confidence.